Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
And as the Q4 earnings season begins to ramp up, we thought it'd be a good time to check in with our research director, Shiraz Mian. He keeps his eye on this period of time 4 times a year for us, and he's going to fill us in on what's been going on.
Sure.
Q4 turning out to be, so far, there's a small percentage of companies that have reported at this point, but a mixed bag as far as the household names are concerned.
Yeah.
So is there any one major theme that you see emerging here from this Q4 season?
The expectation all along was that growth was going to come in 2017. We got into positive territory last quarter in the Q3 of 2016. And this is kind of a transition phase to take us from the end of the earnings recession into the growth phase, and it's progressing as expected. It is a bit of a mixed bag. You're right, but it's relatively early. Right out the gate, finance gave us a pretty good start, and the growth pace isn't bad. It's better than what we saw in Q3. As I wrote in my earnings preview, it's the highest growth rate on track in the last 8 quarters, and when all is said and done, perhaps even higher. So growth is the key word. It's a transition phase, and there's more confidence in the expectations for the coming periods that the growth that we saw last quarter and in this ongoing earnings season will continue.
And we're going to get to talk a little bit more about that growth in just a little bit. So we're in the first 100 days of a new presidential administration.
That's right.
Here, right? Everybody is waiting to see what happens.
That's right.
Markets kind of stalling out.
Spirits and,
yeah. So how long do you think before we get a good picture of just how the new administration's policies are going to affect corporate earnings?
My sense is that we'll see the legislative changes taking concrete shape over the next 3 to 6 months. Perhaps they get enacted in the second half of the year. Once we have the proposals on the table, the actual policy in black and white, we'll start seeing discussions about the earnings impact of all of that, whether it's regulatory changes like Dodd-Frank for finance, whether it's tax policy changes, and even some of these trade issues. So I think the actual concrete impact would be a 2018 phenomenon,
okay.
But the details of it should start emerging over the next 3 to 6 months. But I must add that in the finance sector earnings that we saw for Q4, and that's going on right now, we are starting to see some impact already. So interest rates went up, confidence increased, there was increased volatility, which pushed the trading volumes and revenues for a number of the banks. In fact, pretty much most of the banking outperformance was because of increased trading volume, which really ramped up post-election. So some earnings impact has started showing up already.
So as regulation in the financial sector begins to take hold, that is where it may show up first.
That's right. So we need to see is there a minor tweak to the Dodd-Frank regulation for finance sector, for example, or they just an outright rewrite of the whole legislation. Same on the tax law changes too. There's a lot of discussion about how the proposals in the air would benefit exporters at the expense of importers and retailers, but all of that is up in the air right now. We don't really know what the concrete shape of all of this will be. Somebody had referred to the legislative process as sausage making, or so not sure what comes out of it.
Okay.
It's not pretty.
All right, we'll leave that right there. I know you enjoy those analogies.
Sausages, they're tasty, but it's probably not very nice to look at when they're
As
making
it's
them.
being made.
That's
All right,
right.
show us what we have so far. What's that scorecard look like?
Okay, so we have, as of this morning, we have 80 S&P 500 members have reported results. I'm sharing the complete scorecard here. That's about 25%, almost 25% of the index's total market cap. So it's a relatively finance-weighted sample at this stage, but relatively representative. Earnings growth is 5.1% for these 80 index members on 1.9% revenue growth. 71.3% are beating EPS estimates, and 52.5% are beating revenue estimates. And just to put the growth picture in comparison, I have these two side-by-side charts. The left hand is showing the aggregate growth picture for Q4 that's emerging now, and then compares it to what we saw in the preceding quarter, and then the 4-quarter average and the 12-quarter average. And you could see that growth is, any way you look at it, in any period you compare it to, is tracking better than what we have been seeing over the last few years. And then the right-hand chart basically takes that aggregate picture but strips out finance. Finance has had very strong growth across the board, and we briefly touched on some of the driver of that. And if you could see, the growth turns essentially flat or modestly even in the negative on an ex-finance basis. So it's still better even on an ex-finance basis relative to what we have been seeing in the recent past, but it doesn't look as pretty as it is with finance. But a big reason for that is that the sample thus far is heavily finance weighted, and as we go further along in the coming days, we'll have results from technology and many of the other sectors, and that should even this out.
All right. Talk to me a little bit about the beat-meet ratio so
Yes,
far.
very interesting. As good as the growth picture looks, the surprises aren't looking as good. And I have the slide. You could see that we have 71.3% beating EPS estimates and 52.5% beating revenue estimates. And you could see that this is a lower proportion relative to what we saw from this same group of 80 index members in the preceding quarter. And the EPS surprises are in fact tracking below the 4-quarter average as well. Perhaps it's a reflection of the relatively unrepresentative sample at this stage. We'll have to see how it shapes up in the coming days. But at this stage, at least, positive surprises are relatively hard to come by.
Okay, but at this stage of the game for Q4, nothing to get overly excited about yet.
Well, growth is, as I mentioned, even though driven by finance, is tracking better than what we have been seeing over the last couple of years.
And along those lines, this is going to be the second straight quarter of year-over-year earnings growth and revenue growth.
That's right.
As far as I can tell.
That's right.
So when it's all said and done, as far as growth, is this growth going to be better than originally expected?
Sure, yeah. We are already, in fact, almost 2 percentage points higher than when we got started. So at the beginning of the earnings season, just before the start, the expectation was for about 3% earnings growth. We are tracking about 5% now. And just based on past history and my experience with these numbers, I wouldn't be surprised if at the end of the day, this growth rate comes to around 7 to 8 percentage points. So you would recall that in Q3, we had 3 to 4% growth. If this comes to 7 to 8% growth, that'll be a pretty decent acceleration from what we saw in Q3 and in the quarters preceding that.
Yeah, nice bump up.
That's right.
What about the strong dollar? Is that a fly in the ointment here?
It is, and even though it has started pulling back over the last few days a little bit, but that does remain a concern. And A number of these companies are mentioning that on the calls too. You mentioned some of the mixed picture from the consumer companies, and that remains an issue. We saw that at the beginning of 2016 when in Q1 and Q2 it was a big hurdle, and we are even higher than that level right now. So unless we get offsetting domestic growth, I think this could become a major headwind on the earnings front in the coming quarters.
What about Q1 estimates? What are they looking like so far?
So the expectation, as we mentioned earlier, all along was that growth accelerates in 2017, and that's what was reflected in consensus expectations. We have the slide here where we have the Q4, the ongoing earnings season, in that red checkered type of column, 5.1%, and then the following 4 quarters and the preceding 5. As you could see, growth in Q1 is expected to be 9.1%. This has come down a little bit. It was expected to be about 9.5% about 2-3 weeks back. So still pretty strong growth expected in Q1 and then beyond. And then you could see that the growth continues into the following quarters. And the overall expectation is for double-digit earnings growth full year 2017, which is then expected to continue into 2018. And none of that reflects some of the optimistic expectations with respect to policy changes from the new administration. So all of this precedes what potentially could come with respect to regulatory changes, increased domestic economic growth, and tax law changes.
All right, earlier you mentioned this morning, you referenced that I want to let everybody know that we're talking here on January the 24th.
That's right.
Right, and so the season is beginning to ramp up.
That's right.
But as we get closer to the end of the month is when the peak period is going to hit as far as these reports are concerned.
So we have about 100 companies, S&P 500 companies reporting this week, and then another 100 plus reporting next week. By the end of this week, we should have a decent sample size, diversified enough, representing a broad enough mix of all the sectors to have a good sense of how the Q4 earnings season and expectations for Q1 are evolving.
All right, we're going to check back with you as that peak gets closer. In the meantime, don't forget that Shiraz has written commentary on earnings trends in the aggregate for the S&P 500 companies. You can link to earnings previews on Mondays each week and his ongoing commentary in earnings outlook articles, all on Zacks.com. Link to them all right off the homepage. With Shiraz, I'm Terry Ruffalo. And now, next week,